question in the past question. So I will try and solve it tomorrow by God's grace. I will review the question. I pray I have the time in the morning or early tomorrow morning to review it. So there is that almost more than 20 people have sent me the same question from they are just copying and paste. My WhatsApp server is already jam-packed with the same questions every time. I don't know whether you guys have same vision, but I'll try my best tomorrow to take care of that questions, maybe as our parting gift. All right, so the return is going to be 10% multiplied by the 1,000, which is the face value of the bond. So this is 100. So the return is 100. Then what is the price to call? The price at which I want to call the bond, 1150. Then what is the PD? PD means the market value of the bond. That's 950. No, 980. Right? Then the number of years to call is 4. 1 divided by 4. So I will just do the same. 1150 plus 980. So what is the answer here, please? Oh yeah, calculator.
2,130.
No, let me press my own calculator. Sorry, sir. I love pressing it myself.
Okay.
1150 minus 980. Minus 980 divided by 4 plus 100. So for the numerator, I got 142.5 here.
Yeah.
For the up, 142.5. I love pressing my own calculator myself. So this one, I got this. Okay. Then the denominator is 1150 plus 980 divided by 2. I got 1065 here. 1065. So the year to call is what? 142.5 divided by. So the answer, oh, sorry, is 13.38. All right, 13.38. So who are the winner now? Ima, congratulations. I got 3 winners, right? 3 winners, Ima. So, Mr. Governor, we have 6K on the line. How much are you financing out of the 6K? Governor, how much do you want? You finance all. Thank you, bro. So, Ima, 2AO, and Noble, please send your stuff. Is it through recharge card or do you want to give them money or recharge card?
And details.
Okay, Ima, 2AO, and Noble, please send your account details to the platform. Governor is giving you guys 6K. I mean, 2K each, sorry. So let's stay for this one now. Thank you, Mr. Governor. All right, so let's do the second ones too. Let's do this one. That's the second one. Okay, so this is for semi-annually. Semi-annually. So for semi-annually now, your returns, don't give this is where many people enter one chance there. Under semi-annually now, your year is going to be n times 2. So what is the number of year for the bond itself? The bond is a 5 years, so your year is going to be 5 times 2, which is for 10 years, Abby. Then your NC, your year to call is also going to be, we're told that it will be called in 4 years. That's 4 times 2, we use 8 for it. Then your coupon rate, your coupon will be what? Your coupon will be, it's 10%, 10 divided by 2, which is 5%. So this is just it. This is just 5%. So what is going to be our coupon now? Our coupon will be 5% multiplied by what? 1,000. So that's how much? 50, Abby? 50. So I think, so here is going to be 50. Okay. Then here is will be 1/8. Here is 1/8. So I think that's all. So what's the answer? Here is 50. Here is 1 divided by, this is 1 divided by 8. So just give me the answer now, please. Let's do it together. Let me also do my own. 1150 minus 980 divided by 8 plus 50. So numerator, I got 71.25. Okay, then for the denominator, 1150 plus 980 divided by 2. I got 1065. So my answer is 71.25 divided by 1065. So the answer is 6.69. So who are the winners here too? Pelumi, Ima, 2AO, BBM, Osa. One chance. Solomon, Osa. So Pelumi, Alaja will give you 2K. Ajia, please help me credit Pelumi 2,000 naira. So please send your details on the platform, sir. Pelumi Jayoba, you'll be credited with 2K. Now, Ima and 2AO, they win again. So don't worry. I will take care of Ima
Casey,
2.
Casey, Casey,
Yeah,
hold on just a minute.
yes,
This is the
please.
reason why I got
See,
13.38. Let me justify
Casey,
it.
Okay, explain,
I
sir.
justify nǹkankan ò gbàjọ. Casey,
Hold on now. Let me say something.
Pẹ̀lúmi na big boy
There is a
o.
reason why there is a reason
Casey,
why I
Pẹ̀lúmi
call
na big boy
Yes, sir.
o.
Yes.
I just
Uh,
remember, I no fit dey give
I mean,
Pẹ̀lúmi money o. Pẹ̀lúmi should be the one give me out money o.
no, 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 no. Let's just do it. Whether a big boy or not, at least let him use that 2K to buy malt. Okay? So please, Mr. Pelumi, I know you're a big boy, but drop your account details, collect your 2K. It's your sweat. Enjoy it. Oh, yeah, BBM, continue.
So I actually called that answer just to prove a point, actually. So we got, based on the one you did, you got 6.69, right? So if you
Yes,
actually
sir.
multiply it by 2, you still get 13.38, which was what we got earlier when it wasn't semi-annually. Do you understand? So I just want to use it to, the fact that it's now semi-annual, it's now being paid twice a year. So it's equivalent
But
to if they pay it once in a year. So that was what made me call that answer, just to
but do you
prove
agree
that.
that our answer is correct? Do you agree our answer is correct, Abi?
Absolutely. But I just mentioned that just to
Thank,
prove a point.
thank you, thank
Absolutely.
you. But in the exam, you cannot prove a point. You must get the correct answer. Okay, let's move on from this.
Definitely.
So Pelumi, please drop your account detail. You get 2K. Iman 2AO. Once you drop your details, I will credit you guys 2K each. So you guys won 4K tonight. Let's move on, please. Okay, so that's the end of tonight's quiz. Hopefully tomorrow
I
there
want
might be more
5K.
questions.
Oh.
Okay, 1K plus 2K. Don't worry. You no somebody is giving you 2K. Me, I will give you 3K, Abi. Then 2AO, I'll give you 2
Yes.
2K. I know now. I'm an accountant too now. Don't teach me reconciliation.
Who is Alaja giving 2K?
Alaja is giving Pelumi 2K.
Okay.
Okay, let's move on. Let's move on.
Governor, you're giving me 2K as well.
Waiting you win now.
The
You don't
number
win
you
anything,
have dialed
madam.
is not reachable.
Okay, let's move on, please. So I think with this now, we've dealt with ye to call a bit. If you see ye to call in the exam, you should smile and probably move on from it. All right. So we've dealt with ye to call. If you see it in the exam, there should not be any problem. Now the next thing I'm discussing is duration, right? Should I still go through duration again? BBM taught us on Monday. We should just move on to other things. Do you still want me to repeat duration again? This is duration without convexity. Oh, please just give me a minute. Let me just switch off something. They just brought the light. Just a minute, please. I'll be back. Hey, I am back. Oh. The fear of band A is the beginning of wisdom. When I'm on inverter, I turn on everything. When NEPA is back, I switch them off. Okay, all right. Let's move on. Let's move on. Let's move on. So, as I was saying, this is duration. BBM taught us on Monday. Probably I should just run through it. This is the one Ojobo taught us. So I want to assume that his questions to be based on what it taught us, right? So, all right, this is the question. So, calculate duration of the following bond. Calculate duration of the following bond. We have the face value, which is 1,000. PD is like the price of the bond. Then yield to maturity, which is equivalent to your IRR or rate that was given to you. Then the coupon is your 10%, and the number of years is 5. So what is your duration now? So you calculate your coupon first. Your coupon is 10%, which is just 10% of this value. Note that your coupon is always on the par value. It's always on the face value of the bond or par value. Please take note. Coupon is not on market value, but coupon is on the face of par value. Please take note of that. So once you get that as 100, you draw up your table, year 1 to year 3, year 4, year 5. Then the par value itself, you will redeem it at 1,000. That is if they are silent on the redemption. Sometimes they will tell you that you should redeem it at 5% above the par value. If that's the case, then you are redeeming it at 1,000 plus 5%. Or in some cases, they will just tell you redeem at par. In some cases, they will give you the actual redemption. So here they didn't tell us anything. So we are redeeming at 1,000 naira, which is the same par value. So you will multiply the number of years by this cash flow. So 1 times 100 is your 100 year. 2 times 100 is 200. 3 times 100 is 300. 4 times 100, 400. 5 times 100, 500, 5,000. So you have this here. Then your DCF will now be at your yield to maturity. Remember that the yield to maturity given to us in the question is 12%. So your DCF will be at 12%. Then you multiply your DCF by this new cash flow you arrive at here. That will give you your present value. So your total present value is what you have here, 3837. So your duration is basically the present value of future cash flow divided by the price of the bond. And remember that in some cases, though Jogbo was so direct here, he gave us the price of the bond. Some question will not give you price of the bond. So if your question did not give you the price of the bond, then you must calculate your price of the bond using your normal, that means your price of the bond will equal to all the cash flow, okay, all your you discount all your coupon plus the redemption value. That's going to be your price of the bond. So okay, so but in this case it was direct. He gave us the price of the bond. So duration is this 3837 divided by 950, which equal to 4 years. So that's the duration. Okay, so that's how to calculate duration. And note, if the redemption value is not given, please, your bond should be redeemed at par. That is exactly what we did here. We are not giving redemption value, so we have to redeem our bond at 1,000 naira here because redemption value was not given to us. So let's move on, please. Let's move on. All right. So I have another questions here too, which I solved now. Let's just look at the questions now. A part. A firm has in issue 7%. A firm has in issue 7% on dated bond. A firm has in issue 7% on dated bond, each with 100 naira nominal value. The current yield is quoted as 7.42. So calculate the market price of each bond. The yield is quoted at 7.42. Calculate the market price of each bond. So first of all, this kind of bond now, you are not told whether the bond is redeemable or irredeemable, okay? Because they stated that the bond is undated. Undated simply means that it does not have any timeline. That means the bond is irredeemable. How do I know that it is irredeemable? Number one, the number of years was not given. And number two, the bond is not dated. That means it is perpetuity. It is irredeemable. So a firm has in a 7% bond, coupon is 7%, of undated bond, which is 100 naira. That's the face value. Okay, the current yield is what, 7.42, right? Calculate the market price of each bond. So how do you calculate the market price of irredeemable bonds? It is very simple. It is your annual coupon divided by your HAR. Your HAR is your yield to maturity. So in this case now, our annual coupon is 7, which is simply 7% of 100, right? So you divide by your higher HAR rate, which is 7.42. That will give you your market value of irredeemable bonds. So the value is simply 94.34. So that's how to calculate market value of irredeemable bonds. So the formula is annual coupon divided by your yield to maturity. So that is the formula to calculate market value of irredeemable bond. The same thing is applicable to irredeemable preference shares too. Okay, the same formula is applicable to irredeemable preference shares. So under preference share, it will just be the dividend divided by your HAR. That's for preference share. So the same formula is applicable to it too. So let us move on now to the next one. So I think this should be the last one
JC,
before I move on to convert. Yes,
JC,
please.
who are
Yes,
the
please.
3 people that won the first prize? The first that got the first question.
3, Ima, 2AO, and Nobu.
Who is
I
True?
told
Who
them
is
to
Noble?
post. They are on this call now. Oh yeah, Daruko,
Random
so that
people
your
have
governor
been
can.
posting their candidates, so it's better we know them all.
You mean people have been posting? Why are people like this now? Let's be matured, please.
And I've been deleting it.
Why are people like this now? Let let us be matured now. I know them.
Who is
It is
2AO? Who is Nobu?
2AO. You to tell us your name now. Governor the para.
Juel is Ajibike Afis. It's Ajibike Afis.
Did you say Ajibike Afis there? Please pin it. I also need to credit him 2K. Then I'm crediting him at 3K. Then Pelumi too should post so that Alaja can do that one. Okay. All right. So you mean I know people are posting their accounts. Tinubu economy don't eat people. It is well. I pray it will not eat us and our household by God's grace. No matter how tough it is, we'll survive. Yeah. Okay. So this is just the one for the redeemable. Let's move on. Time is running very fast, and I still have so much to cover before BBM come in by 11. So look at the B part now. I want to take the B part now. A bond as an issue. 8% 100 naira nominal value bond redeemable at a 5% premium in 10 years' time. The current yield on the bond is quoted as 10%. Calculate the market price of the bond. So in this case now, we have to calculate the market price of a bond. This is quite straightforward now. So what is the market price of the bond? The market price of the bond basically is when you discount your coupon plus your redemption value. Now, in this case now, the coupon is 8%, right? The nominal value is 100, and it is redeemable at a 5% premium, which means that if you are redeeming at 5% premium, it will be 100 plus 5%. That is 105. So which means that you are redeeming this bond at 105, and the number of years is 10 years. Then the current yield, which is the yield or interest, is 10%. So just do that. 105 is your redemption year. Then 8 is your interest. So the market price of the bond is basically the summation of your coupon plus redemption. Okay. So I believe that has taken care of this now. So now let's move on to one of the main topic for tonight. I posted a couple of topics this afternoon that I'm going to cover. So the next one I'm doing now, I'm taking, how many topics did I post, Seth? Just let me check tutorial group. Hey, account number. Okay, Emmanuel has posted his account. Who else again? Okay. Please, who won the second prize? My network is. Pelumi Ope. Thank God he has posted. Okay, Fatih. Okay. Okay. I've seen many account details here. So see what I posted today. See what I posted that we are discussing this evening. Yeah. So Kazim, I'm taking you to call. So you to call now. I think it's done. Then convertible security is the next one I'm taking now. When I'm done with convertible, I'm taking equity valuation. After equity valuation, I have risk, then pass questions. So help me God. I have to do all this before 11. So let's quickly take convertible now. So that's the next topic. Then BBM will come in by 11 to take stock market trading and multi-period growth. He was taking that. So let's move on to the second topic I have, which is convertible. Thank God I have my question and solution on the screen. So I'll just say all I need to do is to run you through it, explain it, and we'll move on. All right. So when we say convertible, what is a convertible security? So convertible securities are those securities that has the features of both debt and equity. So they are known as an embedded securities, right? One instrument has the features of both debt and equity. That is why they are known as convertible. They have the features of both debt and equity. So that is why they are convertible security. Okay, they have the features of both debt and equity. That's why they are convertible what? Security. Are you guys with me? Then why do you do a convertible? Please, this is Ojobo. Ojobo, we might ask this. Why do you convert security? Number one reason why you do that is to reduce the exposure or leverage, right? That's one of the reasons why you do a convertible security, to reduce exposure or leverage. The second reason is to save the companies from collateral. Please, if you have to cram this, Ojobo might ask, or he will ask, or maybe not, okay? To reduce the company exposure, it saves the company from collateral. And when there is a crash in price, it is advantageous for the company to convert. That's why I put it in red, because Ojogbo, his style. Okay, so these are the three reasons why you do a convertible. Now, when you are doing a convertible, there are some things you need to consider. There are about 7 of them. The first one is the investment value. What is investment value? Investment value is the worth of the investment, right? The current worth of the investment, that is the investment value. Then the second one is conversion ratio. What is the conversion ratio? The ratio of shares to be issued for debt. That's your conversion ratio. The ratio of your shares to be issued for debt. That is conversion ratio. Then the next one is the conversion value. So this conversion value basically is your number of shares multiplied by the number of the price per share, right? The ratio multiplied by the market price of your shares. That's your conversion value. Then let's move on now. So we now have POI and POC. So what is POI? POI means premium over investment. So this premium over investment is just the difference between your current market price and your investment value. Let's say your investment value was 1 million and your market price is currently at 1.5 million, whereas what you invested was 1.2 million. So the difference of 300 is your POI. But POI can be either be done in value or in percentage. If you do it in value, just subtract your investment from your market price. You get your POI. That's premium over investment. Then for your this one, for to get it in percentage, is simply your market price minus investment divided by investment, which is the base figure, multiplied by 100 over 1. Note that this investment now, you will calculate it. Okay, I will show you how to calculate it later. Then we also have POC. That's premium over conversion. So this one is very simple. It is still the same market price minus conversion value. Okay, market price minus conversion value. This conversion value is your number of shares multiplied by the market price per share. That's your conversion value. The number of shares you are giving multiplied by the market price per share. That's your conversion value. So please take note of that. Then for the combined, the third one is your combined premium. So combined premium basically is where you add up your POI with POC. Okay, you add up your POI with POC. That's your combined premium, which means that you are adding up your both the premium over investment with that of premium over conversion. That's your combined premium. So for the value of the company, so that one basically is your returns. You have to discount all your returns, which is this formula you have here, summation RT divided by 1 minus KC. You discount all your returns plus CR multiplied by PE into bracket 1 plus G raised to power NC divided by 1 plus KC raised to power NC. So that's the formula for that. Okay, so that's just the formula for that. So let's take a question on convertible bond now. Let's take a question on convertible bond. So this questions too, it is in red because it is Ojobo's question. So most likely it might just repeat the same thing. You can see this question is in red, so it is Ojobo question. A, B, C, D most likely it might likely ask except E. It cannot ask us to do A, B, C, D. Ask us to do E. It's not possible. There won't be time for that. But A, B, C, D, they are confirmed. E, you can ignore E. Cannot ask you to compute A, B, and still ask you to redo E again. Which means you are repeating solution 2 times. All right, so let's read now. Unilag PLC has a 12% 1,000 bond that is currently selling at par. Cost of debt is 14%. Cost of debt is 14% and number of years to conversion. Cost of debt, is 14% and number of years to conversion is 5 years. The bond is expected to mature in 7 years' time. That means the total number of years for the bond is 7. Whereas this bond, we can convert it in 5 years. But the total number of years of the bond itself is 7, but it can be converted in 5 years. Now, the conversion ratio is 40 shares to 1, which means that if you want to convert, you take 40 shares to one bond. Why the company market price per share is selling at 20. So with this now, if you want to know your conversion value is just this 20 times 40 shares. That's your without even thinking twice. Your conversion value is your 40 times 20 shares, right? The cost to conversion is 15, assuming growth rate of 10%. So determine A, the premium over investment. B, premium over conversion. C, combined premium. D, appropriate price of the bond, and assuming discount also something. So let's just take that. So all these questions, whatever we have here is what we have been able to quickly summarize here. So coupon is 12%. So all what we have here, we have listed them. Our coupon is 12%. The par value is 1,000, which is your face value. Then what other thing? The year to conversion is 5 years. The total number of years is 7. Where is that? Year to conversion is 5. Total number of years is 7. Then the return is 14. Where is that one? Assuming where is the return of 14%? It's also okay, it's 14%. Yeah, cost of debt is 14%. That's the return, 14%. Okay, cost of conversion is 15%. So calculate premium over investment. So your premium over investment, what you do basically is you need to calculate the current worth of investment, the investment value, right? What is the investment value? So for the market price, the MP is very simple. Your MP is your value of the bond, which is the current value of the bond. This is 1,000 naira. 1,000 naira is your market price. Okay, MP is the current value of the bond, which is 1,000 naira. Well, for this IV, you must go and discount your returns plus your redemption value to get your IV. You will go and discount your returns plus investment value. So in this case now, how do we get our IV? Like if you have to look at this table, the returns is 120 for 7 years. How did you get 120? The coupon is 12%. The coupon is 12% multiplied by the par value of 1,000 naira. So that is how we got 120. Okay, that's how we got 120. Then your year 7, which is the same conversion, the amount we are redeeming it for, that's at year 7. So that gives us the 1,000. So that gives us the 1,000. So by the time you discount this, you will know that your PV is 914. So this is the PV 914. So by now you should know the formula for the cumulative DCF by now. So that's how to calculate your. So this is 914. MP is 1,000 and PV is 914. So if you do that now, you get your premium over investment, which is 9.38%. However, your premium over investment, so if you don't want to use it, do it in percentage. Just say 1,000 minus 912. Whatever answer you get is in naira. But in percentage, is 9.38. Just divide it by the base value and multiply it by 100. That's in percentage. Okay. What about premium over conversion? This one is like a bonus because you already know that your MP is your fair value of our face value of the bond, which is 1,000. The conversion value is the number of shares multiplied by the price per share. Okay. That's now. So why I'm not considering growth rate? We're giving growth rate. Does anybody know why we're not considering growth rate before I answer it? Does anybody want to attempt? Don't worry. The governor is not giving anybody money now. Does anybody want to answer why I'm not using growth rate? Hello? Who want to answer why we are not using growth rate here? That we are just taking direct figure as our CV. Anybody? Oh yeah, attempt. Well, about 50 on this call, and no one could attempt this thing. Why are we not using the growth rate? Hello, can you guys hear me first of
Because
all?
there's
Let me
no
check.
dividend.
Okay, you are not using the growth rate. That's not the correct answer. You are not using the growth rate because you are assuming that it will be converted today. Okay, that is why we're not using growth rate. If it will be converted at the future day, then you have to use the growth rate because we are assuming that the conversion is taking place now. So we only work with the current data we have. So that is why we are not using the growth rate. Okay, so that's the answer. All right, so here is 840 times 20 CV. So do that, you get 25% is your POC, premium over conversion. So how do you get your combined premium? Your combined premium is the answer you have for the POI plus POC. That's 34.38%. Then this one, he never solved it for us. I think we have solved it, correct? Yeah, we have done that. So for this one now, see all these jargons you have here. This N summation T is equal to 1, RT divided by 1 plus T. Here you are just discounting all your cash flow, which is what we have done here. You can see our cash flow you are only discounting it for the 5 years. After 5 years, the bond is gone. It's only you are doing it for 5 years alone. So your cash flow is 120 for 5 years. That's 402.5. Okay, 402.5. So that's 402.5. You have it here. Plus what? This is CR conversion ratio, which is 40 shares, multiplied by PE. That's the number of share. Okay, multiplied by PE. That's 40 times 20 plus 1 plus G, your growth rate, right? Plus 1 plus growth rate raised to power NC. NC is the number of year to conversion. You can see it here. NC is 5 years. Then you do the same thing. 1 plus KD, your cost of capital raised to power 5, which is the NC. So if you do this now, your PO is 1042. Remember, Ojogbo did not solve this one for us in the class, so but we had to solve it here on our own. He did not give us, he didn't solve this price of the bond for us. Please take note. So for your exam, my predictions are A, B, C, D. Okay, A, B, C, D. These are my predictions for exam. I've made it in bold. So please practice A, B, C, D very well. The E is just for maybe, because if you have to do E, you have to repeat the entire stuff. That is, you have to repeat the entire process again if you want to do E. Okay, so I don't think it will bother us much on that because there won't be time for that. So that's just for A, B. So that is for convertible. Please, any questions for me on convertible? I'm checking my time. I have just 1 hour, 5 minutes before the next person start his own part. Any questions for me on convertible? So this is just what Ojogbo taught us on convertible. So you guys need to practice it very well. You might just repeat the same questions or add 1 or 2 things to it on convertible. So this is just the only thing that I recommend that you focus on convertible. Any questions for me on
Casey,
convertible? Yes, Solo.
is the last part is solved. That
Okay,
last part,
I should
the
repeat it, Abby.
no, just scroll there. I want to ask a question there.
Okay.
Scroll there. That appropriate price for of the bond where you use
Yes,
the
this is it.
scroll up
I'm there.
the
Okay.
solution. The solution.
Yeah.
Okay, okay. Scroll.
Okay, see, all these things you have here, all this end summation, T is equal to 1, RT minus root divided by 1 plus K. Everything is just for you to discount your
Yeah, I know.
returns.
Okay, so
Which
Casey,
is this? You discount your returns. Yeah.
the question here now is, this left part of the formula is
Mm,
saying we should discount,
our returns.
using the what's that T? What does the T represent?
The
Is it
time,
the
time T, which is 5.
5? But in the question, I'm
Yes.
saying 7.
After 5 years, when you convert the bond, what else again? Shop don't close now. Your bond is you're only converting it after
Okay,
5 years. Once you convert it, there is no more bond after 5 years now. So your market
okay,
price is
okay,
for up to 5 years. Do you
okay,
understand,
okay.
Abi?
Yes, I get it now.
After 5 years, shop has closed. So nothing
Yeah, I'm just
again.
trying to get
So
the logic behind this.
yeah, it is only for my market price for 5 years. Since once you convert it, that's the end. That's why we are
Okay,
considering this conversion ratio multiplied by the market price. That after 5 years now, what is the value? That's all. So
okay.
everybody, I hope this is clear to us, Abi. Are we good with convertible? There is anybody raise hand?
Yes, I raised my hand. Sorry. Please, can you scroll down
Okay,
to the
I
next
should.
question you solved?
You mean this one, Abi?
Yes,
This
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 past
one?
question. That past
Yes.
question.
This one.
So, as in, no, not this one, not this one. The
Which
next
one?
question.
This one, Abi?
The next question, the past question. Yeah, this question.
Okay.
Yeah. So, while trying to solve the conversion premium, I saw that you used the floor value.
Okay, this is actually not a past question. I actually got this question. I don't even know where I got it from. I just tried to use this on these particular questions now. I tried to use what's it called? The assuming that there is a growth rate, I factor in the growth rate here. So I think I should explain the rationale behind this question as well, so that we can all be home and dry, correct? So let me just explain it again. Okay, I thought I should just limit your knowledge to what would. Oh, guys, do you think we should we just focus on Ojogbo or should we review this one again? I don't want to confuse also. Should we focus on Ojogbo's question alone and move on? What do you think? So that I don't dwell more on this particular one. This one is not. This one is outside class question, right? Is ICANN question. Hello.
So I just want to know why you used floor value.
Okay, I have to re-explain it again. Okay, let me just rush through it fast in about 2-3 minutes. Okay, a company has an issue 9% bond, which are redeemable at their nominal value. So this is 9% bond, and the nominal value is 100, and it should be redeemable in 5 years' time, right? That's the number of years is 5 years' time. Alternatively, each bond may be converted on the day to 20 ordinary shares. That are 20 shares, and the market price PE is 4.5. This is expected to grow at a rate of 6.5%. The growth rate is 6.5%. G, 6.5%. Expected to grow at a rate of 6.5% per year for a possible sure. And bond holder requires 7%. That's your IRR. Okay. Your IRR is 7%. So require calculate the market value. So your market value basically is your IV. Do you understand? Your market value is your IV. So your IV is your market value. So how do you get your IV? Your IV is your coupon. What is our coupon? 9% of 100. That's 9, Abby. 9 is our coupon, right? So you discount it at 7%. That's about 4.1. So this is our coupon. Now, in case of a growth rate, your redemption value, please take note. Your redemption value is the higher. Your redemption value is the higher of the actual redemption value, that is the nominal value, and the what? The market price of equity. In this case, now the nominal value is basically 100. That's the 100 per shares, right? That's your nominal value. What then? If you want to consider the market price per share, now for the shares now, it has a growth rate of 6.5%. So it will be PE, the price of your shares, into 1 plus G. That's 1 plus growth rate, raised to power the number of years, which is 5, multiplied by conversion ratio. You will get 1.121.94. So the higher of these two is actually your redemption value. So which is 86 points. So the total market value of the bond is 123, which is the first requirement here. Market value of the bond is 123.45. Then the second one is the floor value. So I think what is the floor value? The floor value is the value without the option of conversion. So if you are not converting at all, that is your floor value. So the floor value is basically the value without conversion options, right? If you are not converting, what is the floor value? So in this case, now you see the same coupon and redemption value is 100 because here we are not converting. So this is like the normal value of the bond. So the normal value of the bond is 108. But if we are converting the bond, the value is 123. So your premium will basically is the 123 minus the 108, which is 123 is your market value. The conversion value is 108. So the difference is your what? Is your premium. So this 108 is the value without the option of conversion. Why this 123 we got here is after conversion. This is your value. If you convert, you will get this 123. If you don't convert, you get 108. So the difference between the two is your premium. So that's the logic behind this question. It's actually an ICANN question, right? So that's the logic behind it. So if you convert, you get 123. If you don't convert, you get 108. So the difference is your premium. I don't know if that analysis is clear now, Afoma.
Yeah, it is. Thank you.
Thank you. All right, let's move on. So I believe that now I can leave convertible security now. Let's move on to other things. So I think this one too was a quiz, which we did last week. I gave you this one as a class work, and some people actually want money. They want price on this question. Let's move on. No need to review it again. Then I also gave you another one. So calculate the value of a bond with the 30% coupon, 20% face value of 2,000, and as an infinite useful life. So some people too want money the other day on these ones too. So if you are the one that want money, congratulations. So the next thing I'm discussing before I move on to risk and return is equity valuation. So I'm moving on to equity valuation. So please, I'm begging us tomorrow. Let's make sure we join 9 on the dot. I have past questions that I want to solve, more especially the questions that you guys are sending to me. I saw it on the past questions, so I will practice it and solve it so that I don't know if you guys have seen vision in your dream, or almost more than 20 people have sent me the same thing from the past question directly. So I'll try and solve it tomorrow, God willing. So please let's join 9 on the dot for that. Okay. The next topic we are discussing is equity valuation. Equity valuation. So what is equity valuation itself? Equity basically is the residual interest in the asset of an entity after deducting all its liability. So once you remove your liability from your asset, whatever that is left is known as equity. And equity holder, basically, these are the real owner of the company. They are the owner, they are the one that owns the company, and what they are entitled to as their money is known as dividend. So equity holder are entitled to what is known as what? Dividend. So how do you now value dividend? There are different methods of valuing dividend. We have Godon method. You know, this Godon method was criticized because Godon method assumed that the company does not pay tax and any does not grow. And in the real life, a company's pay tax and any also grow, Abi. So you should know why method were criticized. Or it is also important you should know. So please let me repeat myself now. Godon method was criticized because number one, it assumes that a company do not grow. Number one, it also assumes that it assumes that a company does not pay tax and the company does not grow, which in real life, it is not correct. Companies pay tax and company also grow. So that is the reason why Godon method was criticized. So please take note of that. Company pay tax and company grow. So that's another. So Kruji too came up with his own method too, which was also criticized. So the only method that is now applicable for equity valuation is known as DDM, discounted dividend method. So this is DDM, okay? So there is a formula for DDM under a constant growth rate and multiple, and when you have a multiple growth rate. So this formula here, you use it whenever you have a constant growth rate, when you are given only one growth rate. So your earnings, E is your earnings, 1 minus B. Your B is your what? Retention rate, right? Retention rate. If your dividend payout is 20%, that means your B is going to be 80%. Your retention rate is your B. Then K is your cost of equity. RB meaning your IRR multiplied by your retention rate. So if you have a constant growth rate, please use this formula for your market price per share. I mean, for the market price, if you have a constant growth rate, please use this formula. But where you now have a multiple growth rate, my people, okay, and there was a clause that Olowe told us that industrial's earning is expected to grow by so something. If that clause was not given to you, that clause that Olowe gave us, I don't know if you guys remember the clause. Let me open my book and read out. If you remember the clause, please read it out for us. Otherwise, I'll just open my book and read out that clause. So this is the formula for multiple growth rates. You use this formula for multiple growth rates, and if that clause, I'm trying to look for the clause. There is a clause that any industrial any is not supposed to grow by so something. Olowe gave us that clause, that if that clause was not given, then this is the formula that we're okay. Look at the clause. If industrial any multiply is not given, so you use this formula. But if industrial any multiply is given, you use, I will show you the second formula that you will use. So this is the formula that you will use for multiple growth rates. If industrials any multiply was not given. Okay. Now, this is Ojogbo's question. And remember, Ojogbo just wrote this question on the board. He did not solve it for us. He wrote these questions for us on the board and he did not solve it. So if you are not paying attention to this question, you are actually wrong, my brother and sister. If you are not paying attention to all the questions that Ojogbo wrote on the board without solving it, you are wrong. Oh. You are wrong. So this particular question, he wrote it on the board, he did not solve it. So let me try my best. Okay, I'm not even trying my best. I've already solved it for us. I will just try my best to explain it again for us for the last time this semester. Okay. Your company, this is the question. Your company paid a dividend of 80 kobo per shares. Your company paid a dividend of 80 kobo per share. Directors of your company think that earning and dividend grow at the rate of 8% per annum for the next 10 years, after which it will increase to what? To 10%. That means for year 1 to year 10, your growth is 8%, right? Then from year 10 to perpetuity, it will be what? 10%. Now, the earning per share is 3.6 naira, while the investor's rate of return is 15. Calculate the market price of the company. So your current dividend is 0.8, Abi, and your growth rate for 10 years is 8%. After 10 years, it will be 10%. Then your earning per share is this, the RRR is this. So the first thing you need to do is you need to calculate. So this is the formula, ladies and gentlemen. Your formula is summation DO 1 plus G raised to power T divided by 1 plus KET. So when you see the summation, it's so that you have to use a table. But you cannot use a compounding DCF formula for this. You must do it one by one. So first of all, let's forget the right side. Okay, let's forget the right side of the formula. Let me teach you how to determine this left side first. This DO 1 plus GT raised to power T by 1 plus. Let me teach you this one first of all. Please forget about the right side, ladies and gentlemen. Let me teach you how to determine the left side first. So for the left side, we want to do this. So this is the table you prepare for it. Okay, you prepare this table. So we have how many years? Year 1 to year 10. Oh, year 1 to year 10. Now, your dividend at year 1 is 0.8. At the beginning of year 1 is 0.8. That dividend will grow by 8%. If something will grow by 8%, that means it will be 1 plus 8%. So 1 plus 8% is equal to 1.08. So your growth for the first 10 years is 1.08. That's why I just repeated it downward here. 1.08. So 0.8 multiplied by 1.08. That means dividend at the end of year 1 is 0.86. Now, this dividend at the end of year 1 will serve as the opening for the beginning of year 2. So it will also grow in year 2. Then it now becomes 0.93 at the end of year 2. Then it will serve as the opening for year 3. It will grow by 1.08, and at the end of year 3, it becomes 1.01. Then it serves as opening for year 4. It will grow again. Okay, this is how it will keep growing. So forget about the DCF and PV first. Understand the growth, how the dividend is growing every year. So you do that year 1, year 2, year 6. So your closing in 1 year is your opening year. It will grow, then you get your new closing. Like that up to year 10. So at the end of year 10 now, it is 1.73. Then you can now do your DCF, which is your IRR was given as what? 15%, right? Investor rate of return is 15%. So you do your IRR. Unfortunately, you have to do it one by one. You cannot do a cumulative IRR since your cash flow is not constant, right? So you do it year 1, year 2, year 3, year 4, year 5 to year 10. So if you do that, your IRR, so your PV is this. So PV, when you sum up this TPV, that's 5.7561. So the total for this value you have on this left side is the total you have here. 5.7561. That's it. So you can see this to everything we have here is equal to 5.7561. Then you will now move on to the right. Let's now move on to the right side of the formula now, which is actually very simple, right? So for the right side of the formula, it is very simple. In fact, let me delete all this analysis I did now. Somebody told me there is a shortcut to it. What is the shortcut to it? The shortcut to it is your dividend at the beginning of year 11. Okay. What is the dividend at the beginning of year 11? It is simply your year 10 end dividend, which is 1.73. Okay. So this is 1.73. Now, this 1.73 is what? Is the dividend here. Then you increase it. It will
Kasim, we can't hear you. Can
not
anyone
be
hear you? Casey, can anyone hear Kazim?
No,
We
we
can't
can't
no.
hear
hear him.
you.
Let me call him.
One
So he wants to change his network. Let's just give him a few minutes, please.
Yeah. Hello, guys. Can you hear me now? Hello, can you hear me now?
Yes, we can hear you now. Yes.
Hello.
Yes, we can
Oh,
hear
We
you.
can
now
hear
I
you.
don't know. I don't know the point at which you guys lost the network. Nigeria and network wahala. It is well, oh. So, and I don't know okay, let me share my screen. Just tell me
Share your screen.
the
Share
last
your
thing you
screen,
heard.
please. Share your
My
screen.
screen is up now.
You are on the year 11, the shortcut they gave you.
Do you understand up to year 10, Abby? How we got this
You've
5.7,
done
5
that.
points?
You've
Okay,
done
that
that.
is clear. So how do you get year 11 now? It will be the closing balance in year 10, yeah? That's your opening for year 11. But your growth rate will no longer be 1.08. Your growth rate will now be the new growth rate, which is 1.1. Do you get it, guys? Your growth rate will now be 1.1. It won't, this 1.1 means 10%. It means 10%. Your growth rate is now 10%. So that 10% multiplied by this give us 1.8999. So that is what you have here. This is the formula 1.899. Now, the formula states KE minus G2. KE is your cost of capital, which is 15%. Your G2 is what? 10%. That's 10. Then multiply it by 1 divided by 1 plus KE raised to power n. N is your 10 years that you are giving. So raised to power 10. So if you do this now, the value of the company is 15.1483. I don't know whether it is clear to everybody. So this is the value of the company. So you add up the two. That's your value, the value of the company. Any questions for me, please? Any questions, or do you want me to re-explain this solution again for us? My people, are we good? Can I
Can you
continue?
please help me
Is
help me
this
with
one
that
with the multiple or without multiple?
This is with multiple now. Ojogo only gave us question for multiple.
No,
Okay,
it was
you want
Olori
me
that
to
gave us
read
question
to
for multiple.
Ojogbo too? He wrote, Ojogbo wrote this question on the board. He just left. He left the class. He wrote and left it. He didn't solve it. Oga no suffer. He just read. He wrote the question on
But
the
this
board and
one
left.
doesn't have multiple.
It's more okay that the industrial is something is able to grow, Abi.
Yeah.
It doesn't have. That was why I used this multiple growth. This is the formula for the multiple growth rate when that clause was not given to you. Olawale to give us this formula, but he now solved the question using the other method for us. So I'm suspecting that Ojogbo will stick with his own question. In that case, we have to use this formula for it. So Cramer's rule. Guys, you have to cram this. So if you want me to explain again, just note the what we did on the left side. This is the table. So once you do this table, get the value for year 11. The value for year 11 will be the closing for year 10 multiplied by the new growth rate, which is 10%. That gives us 1.899. Then you divide it by
Under
your
2 hours,
KE.
Abi.
Under what?
Under 2 hours, Abi.
I don't know that one. No. Okay. So that's just for this. That is for equity valuation, really. So when we get to Olowe's side, we might touch Olowe's equity. Olowe to solve one question for us on equity. Let's move on, Sha. Let's move on. So I think I've covered what I need to cover. So before I move on to risk and return, let me quickly go and solve Olowe's part 2 of equity so that we know that we are done with equity valuation. I think BBM 2 is going to explain more on this multiple growth rate later. So for bond now, ladies and gentlemen, for Ojogbo bond, please take note of this following. This is what you should know for Ojogbo bond. Ojogbo bond. Number one, how to calculate the market price of the bond. Don't sleep if you don't know this thing tonight. Don't sleep tonight. You must wake up and do it. Both redeemable and redeemable. How to calculate your yield to maturity. Okay, yield to maturity. Remember that your yield to maturity is your ARR. Approximate yield to maturity. That's this. See this formula here. Approximate yield to maturity. No, confusion 1B. Yield to maturity is your IRR. Current yield is your coupon divided by your PO. Approximate yield to maturity, that is this formula. Okay, they know how to calculate bond duration. You know how to calculate yield to core. Know how to calculate this convexity is Olowe. They know how to do equity valuation. So this is what you should know for Dr. Ojogbo, please. Now, before I move on to risk and return, which is the last part that I want to discuss, and if I have time, I can take 1 or 2 past questions tonight. Let me quickly discuss the bond valuation according to Professor Olowe, but I will skip the one that BBM covered yesterday. No need to repeat the same thing. Then I will now start. Okay, this is the aspect that Professor Olowe taught us. Convexity, our prof taught us yesterday. Convexity, which other part again did I miss? Okay. Now look at these questions, guys. Look at this question. Look at this question on bond. I want to take, by 10:30, I will start risk and return. Look at this question. Greenhouse company has a bond outstanding with 20 years maturity. Greenhouse has a bond outstanding with 20 years maturity. The bond pay annual coupon interest at the rate of 8%. The bond is currently selling for 761. Determine the bond precise yield to maturity and the approximate yield to maturity. So your precise yield to maturity is the same thing as yield to maturity, which is your IRR. Please take note. Your precise yield to maturity is the same thing as yield to maturity, which is the same thing as your IRR. So we have done that here. We have to use a lower rate and higher rate. Guess what we do? Your IRR will always most likely fall within the range of your coupon, right? That was why we tried 10%. We now try 5%. I think we got what did we get, sir? We got 9.4 as our IRR. Then approximate yield to maturity, you apply these formulas to. So that one we got 8.2. So we've solved this. Then the big part of the question, the setting of investment objective is as important selection of investment asset. Identify and discuss in detail the key factors of consideration in setting investment objective. So this, yeah.
Casey,
Yes, please.
you are not, I feel on that one A part, you should stress the par value of the bond.
I should stress the what?
Par value of the bond. You know it wasn't given.
Yeah. So the par value of the bond, basically the par value of the bond, right? So that's equal to 1,000 naira. Sorry. Hello, guys. You know, bond can either be at 100 or 1,000 naira. In this case now, they said that the selling price is 761. That means it can never be 100. It has to be 1,000 naira only. So that was how we use 1,000 as the par value here. So it is either 1,000 and 100. So if selling price is 197.61, that means it has to be 1,000 naira. So bond is either 1,000 or 100. So 8% of 1,000 gave us 80. Thank you so much for that. So B part 2 is story. You can check, read up on this B part. C part 2, we've solved everything here. Please read up. Yeah, this is where I'm going to. This is where I am going to. Olowe's part of the equity. This is the second equity valuation, Olowe, where industrial something was given. Equity valuation. Prof. Olowe. I shouldn't be calling Olowe like that. It's Prof. Okay, so look at this now. ABC Limited.
Make them not go report you too. Say you know even they put prof again because when I the verse.
Because we did tutorial,
Because when I the verse. Now you go now they call now. Don't even call our doctor again on your platform.
It is well. When I see him, I used to call him doctor now. So forget. Doctor is title is not in his date of birth. Okay. He's not on his birth certificate, his title. Okay. ABC Limited has just paid dividend of 0.8 naira per share. Okay. ABC Limited has just paid 0.8 naira per share dividend. And a director of ABC are of the opinion that earnings and dividend will grow at the rate of 10% for the first 10 years, after which it will increase to 12%. The current earning per share is 4 naira, and the shareholders' rate of return is 15%. Now, the industry earning is expected to be 9 in 10 years. So, because of the clause that this clause you are giving now, you cannot use that multiple growth rate formula again for it. This is the formula that you will use. If you are giving industrial earning is expected to be something in so years, you cannot use that multiple growth rate formula according to Olowe. So you have to use this formula here. Let me put it in red so that you guys know it's a danger to be cramped. So this formula have to be cramped. How do we cram this one by God's grace? How about if I cram a labor? Eh? How will I cram this one? It's too long.
We don't need to cram it. By constant practice, it will just stay automatically
Constant practice. Today is
in
Wednesday.
your
Exam is
head.
on Saturday. Exam is on. I'm sure some
And
people have
now,
already crammed it.
you want
Okay.
to tell me that Emmanuel hasn't crammed it already?
I know that one another species of human being entirely. Don't mention it.
I know they there, Mona, leave me alone.
Ima, have you sincerely crammed this formula, Ima? Sincerely, no lie.
Ó ti
Ima,
wà lórí ẹ̀. Ó ti wà
you've
lórí
crammed
ẹ̀.
it.
Small.
Don't worry, we'll sit together and on the exam day, you just call it for me. I don't need to stress myself. You call it for me. You cram this one, I'll cram the rest. Let's do division of labor. Ogbeni na money and how to be successful in life, they my head, not to be cram all this formula. I beg. I have limited size of memory for all this formula. My head is filled with so many things. Okay, don't mind me, please. Please, guys,
Kazi,
cram
no
it. Cram.
whine us. Oh. Don't whine us. Don't whine us that you've not crammed the form.
See you, for me. You will sabi person now. You still dey do person. I never cram anything, no. Okay, let's move on. ABC has just paid 80 kobo per share. That's dividend per share, 80 kobo. And in the author of ABC, our opinion that dividend earning will grow at the rate of 10% initially, then it will increase to 12%. So we have 10 initial growth, and subsequent growth is 12. Then the cost of capital or shareholders return is 15. And when you are given this clause of industry earnings expected to multiply, you use this formula. But if you are not giving the industry earnings expected to multiply, you have to use that dividend growth method. So can I give you a classwork now to solve this question using, I will delete the clause of industry earning. Can we try it? Should we place a price on it? How much this one should be? Should we try it, guys? Are you ready for the challenge? To
Ó
solve
máa
this
jẹ
question using
time
the
o.
5 minutes,
Using using that long table.
Check out,
Time máa lọ.
yeah, Kamashabi.
Time máa lọ.
Okay,
This is
let me give
10:30 already.
I don't know. I would have loved them to solve it. I
You
want them
can
to
just
practice
give it
that table.
for personal practice. So if you like, do am. If you
Assignment.
like, no do
Okay,
am.
assignment. I will delete this clause. You have to solve this one using the other formula. So to be submitted, even if they send it to me, say, okay, if you send it, I will just go through one person solution. If the answer is correct, I can replicate for others, please. Because I will go through one person solution. And in case you are wrong, I will just forward you the correct solution. So this is going to be the assignment. The same question, but I will delete that clause. So you solve it using this multiple growth rate formula to be submitted probably tomorrow. Okay? Don't show me on Saturday morning, no, that I should review it. Or it may not lucky brain. So this is the question. So I've deleted that clause. So solve this question using the other method. Now that this clause is not there again, that dividend something is expected to grow. So you have to solve it using the dividend method. So please solve this question using that method and send me the solution. If you can send it tonight or first thing tomorrow, I'll be happy. Okay, that's the assignment. But because this clause is there, we have to use this formula. So this is the formula. So just replace this formula with all the vitals. Okay, you will get your answer, which is coming to 27.3. So that's it. So that is it. So I'll send that assignment to the house now. If you can do it, fine. So that is just the assignment.
Please, is anyone there?
Yes.
Speak, no, nobody is hearing me.
Kéèsì ló ṣẹlẹ̀ àgbọ̀ ẹ mọ́ náà.
Network tell me when they speak now.
Báyìí, ìṣé wòye kò ti lọ ń gbé ní street faith báyìí.
Let me just change my network again. I'll join back in 2 minutes.
Yeah, change your network, abeg. Faith, ṣé Katim no dey live for your street ni?
As in how?
The guy network is just misbehaving tonight now. Ṣèbí na only your street network dey misbehave.
Hi.
Yeah, Alpha now. Alpha.
Yeah, we can hear you.
I don't tire tonight, so network does a do shege. All right, I'm sharing my screen now. I've been talking since. Are we together? Hello, are we
Yes, we
together?
can hear
Yes.
you. Yes, we can hear you.
Okay, so I've been talking. So I've explained systematic risk and I've also explained unsystematic risk, right? So systematic risk is through capping. Unsystematic risk, you can diversify through your portfolio. So how do you measure risk? So you can measure risk through your, sorry, someone is talking there. Can the person mute? How do you measure your risk? So you can measure risk through your standard deviation. Should I mute the person talking? Okay, person is muted already. So you can measure risk through your standard deviation, right? Which measure the spread. So the higher the standard deviation, the higher the risk. And the lower the standard deviation, the lower the risk. So for your portfolio diversification, you use standard deviation and variance. Why for CAPIM, you will use beta to measure CAPIM. So beta is what we use under CAPIM. Then the VAR, this one is not video assistant referral. Value at risk is VAR. Is the maximum loss that you can suffer on an investment. That's VAR. Okay. So let's just move on to other thing, right? I want to move on. So to other thing. I think these ones are not needed. All right. So I'm moving on to portfolio proper. So we know the formula for the two variance portfolio, right? So which is your standard, which is your variance square is equal to which is weight of A square, standard deviation of A square plus weight of B square, standard deviation of B square plus 2WAB, RAB, then standard deviation of A, standard deviation of B. So please note that Professor always say we should not go beyond 2 assets. Don't go and practicing formula for 3 assets. Nobody will, you are wasting your time. Please maintain only 2 assets. So I'm looking for, all right, this one is ICANN question. I'm just looking for a question to solve on portfolio, then I will hand it there from my own side. Okay. I'm looking for a question to solve on a portfolio. Okay, sorry, I'm just looking for the question. I've done this bond valuation, which is all the way. All right. So let me move to a portfolio question, and we'll go through that questions together, and I will stop here for my own part. So tomorrow, I know that I'm done with tutorial. It's only past questions I'm going to take for 2 hours tomorrow. So I am moving on to, I'm looking for a portfolio question. Oh, okay. Yeah. Found one already. Or should I just review the past questions directly? Yeah, this is a past question on portfolio. Let's go through this question now. So yeah, they said, consider a portfolio made up of 2 security, X and Y, with the following probability. X, we have 18.5%, 15%, and 25%. Y, we have this. Probability will also give it. So Ayo, an investor has committed to invest 60% and 40% of his budget to these securities. That means he will invest 60 into X and 40 into Y. So assuming 3 scenarios: A, perfect positive correlated returns; B, perfect negative correlated return; C, uncorrelated returns. So determine the scenario that offer the maximum risk diversification effect on his portfolio. So what you do basically is that you bring out the returns of the portfolio. For X, we bring down all the returns and the probability. You multiply the return with probability, you get this. Then you subtract your possible return. This PR is your possible return minus this is value expected return. You subtract it, then you get this, right? Then you square it. You square this variance, multiply it by probability. So you have your answers here already. So that gives you your variance. So when you now square your variance, you get your standard deviation. So your expected return is already this value here. Is your return multiply your probability. That's your expected return, which is 0.18. So this is what you do for security X. You repeat the same process for security Y as well. So you repeat the same process for the security Y. Now, when they now say you should do a perfect positive correlation, so partial correlation means it is +1. So there are 2 ways to it. You can use the formulas for 2 security portfolio for it, but that your coefficient, you now make it 1. Or if you don't want to go through that long process, just use this formula that your weight of X, variance of X plus weight of Y, variance of Y. So that will give you your answer directly. Is either you use this one or you use the normal 2 portfolio security formula. Then you will now make your RAB to be 1 under perfect positive. Then under perfect negative, same formula, you make your RAB to be -1. So you can also use this shortcut. So this formula that under positive you are adding, when it is negative, the same thing, you will just subtract. You get your negative correlations here. Then when it is 0 correlation, so you just take this formula as it is here. Okay, whatever answer you get, do the standard deviation. But note that the best way to diversify is when there is a negative correlation, right? Both assets must not face the same direction. They must face inverse to really get the benefit of diversification. So I think there are a couple of past questions too that I treated yesterday. I might treat them again tomorrow. So as our what's it called? The final, what's it called? Parting gift. So all this analysis that I did on investor preference, efficient frontier, the video is on YouTube. Please go and go through them. Then I also explain the difference between capital market line and security market line. So I don't need to repeat them. Please go through our YouTube video. Then you will be able to have a good understanding of this. So I think I should stop here for BBM to come on board. So tomorrow, all these things I've already explained them before. The videos are on YouTube. Please go and watch the video again on YouTube. Okay, but I might just visit some of these questions again tomorrow to explain how we solve them. I might visit them again tomorrow. But basically, I'm focusing more on questions tomorrow as a final stop. So, BBM, can you come on board now? Let me stop here for you, sir.
All right. Thank you.
Yeah, thank you.
Good evening, everybody. Okay, so I may not also take much time because I like to go offline as soon as possible. Okay, I'm
What's
trying to
that?
share my
What's that?
screen.
What's that? Which one would like to go up as soon as possible?
I'm going to the office tomorrow, so I need to wake up.
Uh-huh. No, we are not going to office tomorrow.
Ah,
What's that?
we are different.
Are you not a choosing? What makes you different?
I'm a choosing generation.
So we are here till 12, and it will not affect
Eh?
office
Go and
tomorrow.
face AK. Go and
We
face
are choosing.
AK-47. Oh. Go and face AK-47.
I'm
Tell
a
me you are
choosing.
choosing.
You know,
You
go
know,
enter.
me, I see going to the office as threat. So any day I'm going to the office like this, I'm always summer. So okay, so I'll be talking on stock markets trading. I hope my screen is visible enough for those that may not be able to see small handwriting. Okay, so we'll be talking about financial markets in general, how it works, and or let me just say essentially the way stock markets, because most of the things we'll be talking about, it's rallies around stock markets, financial instruments, listings, and everything and all. So, I mean, in order to understand this topic very well, it's best when being discussed or whenever you are answering any question, just have a picture of a listed company. I mean, a company whose stock or securities are traded publicly on the stock exchange market. For instance, you can look at maybe Dangote Cement or Dangote Sugar. So these are listed companies. These are public companies whose shares can be bought publicly and can be traded publicly. So financial markets, I mean, it's just like adding finance, to the definition of market. So it is a place whereby buyers and sellers can come together in order to trade financial instruments and securities. So it is a place, and it doesn't have to be physical. Gone are the days whereby it used to be physical, and also there's usually this slang of like Wall Street, Wall Street. I'm going to the Wall Street, Wall Street. So Wall Street is the market for what's it called, for New York Stock Exchange. So when they say they are going to Wall Street, then so it's like a physical place where people go to trade financial securities. But in this current age, we now have financial platform that aids trading. We have a lot of, for instance, if you want to buy stock in the next 30 minutes now, there are apps that you just download, you fund it, then you buy it immediately. So it's now much more digital. So that is the reason why the concept of physical location may not really fly in this term as well. So it is any means of communication, either through computers or mobile phone, whereby you can buy and sell financial securities. Okay, so classification of financial market. So the financial market generally is classified based on different categories, but broadly we have four of them. We have the formal and the informal markets. We have the securities. Okay, level of organization of the market. I mean, talking about how coordinated is the market, how organized is it, how structured it is. So this has to do with the structure. I mean, it's just like having like a multinational, not to speak down on any company, it's just like having like a multinational company and a company that is a small and medium company in Nigeria. Maybe like they just have a total revenue of like 10 million naira annually, then comparing it with a multinational. Well, when it comes to structure, we can all tell that it can never be the same. So same thing in the market. So we have based on structure, we have some market that's, because they are well structured, they are well coordinated, we call them formal. And we have the one that they just do things the way it comes, no proper, there's no bureaucracy, nothing. So those ones are the informal. And as well, transferability, we have the securities and the negotiated market. Securities, essentially they are like markets whereby you can trade your stock, you can trade your debt instrument and all, and whereby like they are publicly traded and all, but negotiated. These are the cases of over the counter, whereby like it has to do with individual. I mean, it's not like something that is public like that, but I mean, you have to go as a person, you make bid for it and all. So it's like an over the counter transactions and all. So and as a form of tenor too, by tenor we mean like the term of this instrument. So we have the money market and we have the capital market. Money market is for short term. Within the frame of 1 year, you've made your money, you've left the market. So we have the likes of treasury bills, treasury certificates and all. Within 1 year, you cash out at NPR, then you leave the market. Whereby we have the capital markets. These are like long-time financial instruments. They can span for 15 years. And many of these instruments, they're like in form of bonds. And we've also seen it whereby like banks can also come together to raise bond together, and so as to finance maybe a state government. For instance, a state government may want to do a particular project, then try to borrow money from groups of banks. So many of this money, they're usually long time that the state may have to be servicing it for like 10, 15 years and all. So, and we have newness of securities or issues traded. That's where we have the primary market and the secondary market. And as we all know, primary market is for new shares, while the secondary market is for existing shares. So just see one as old taker and one as new takers. So essentially that's just it. So just to speak a little bit deep into some of them, looking at their characteristics and what's it called. So as regard formal and informal markets, to make this relatable, just see formal market. Let us use the instance of foreign exchange. See your informal market, see it as your bureau de change guys, and see your formal market as you going to, maybe you are going to Zenith Bank and say, okay, you want to buy dollar and all. So we'll all agree with me, and the bankers can all confirm that before you can just enter, you cannot just enter the bank and say you want to buy forex and all. There are forms. I don't know what they call those forms and all. There are forms that you fill, there are process, there are days it will go through and all. Let's say you want to move money from one country to the other using the bank route. There are processes that can take days before you can wire that money. For instance, there's one of my clients today. They say they want to transfer some amount of money and all, and they're like, we should give them the rate that will be applicable for the next 2 years. That's because the money will not drop immediately, as it will take some while because it's coming from another country and all. So these are some of the properties of a formal market. However, in the informal markets, I can just go to the streets, just go to Tejo show markets there, yeah, but there. You see all those aboki, they will say, dollar, sharp, you don't buy them, you don't come out. So just see it in that manner too. And also the formal market is well structured, things are coordinated, things are well done, and operations are uniform. Operations are uniform and standardized. Information is public for everybody to also see. And it also offers a platform for more efficient execution and macroeconomic policy. For instance, if the federal government wants to do something, or the CBN, easily they can make use of this formal market, but it is usually hard. It's just like black market too. How difficult it could be for the government to regulate the black market. It can be so difficult. And also that's just the distinguishing factor between the formal market and the informal market. Now, this last point is very key. However, despite the development and expansion in the formal sectors, which comprise the mainstream bank and non-bank, just like I said, use FX, for instance, we have the bank and non-bank. When they say non-bank, it doesn't mean bureau de change. It means some other financial institutions, but they are not into banking. Okay? A sizable percentage of economic units still operate outside these sectors, with traditional informal institutions appearing to remain resilient. It's just like our black markets. Black markets cannot be eradicated in this Nigeria. It's not possible. In other countries of the world too, we have black markets, but just that in this Nigeria, due to the economic situation of things, black market is very, very strong, and they are thriving because of what? Because of scarcity. Okay, so as regard the informal market, they are less and there's less organization in the formal sense. So, like I said, use Bureau de Change as example. Operations are largely based on trust, affinity, and peer group relationships. There are sometimes just put a phone call to Aboki Alpha. What's dollar rate? Okay, is this it? Okay, I'll send you $20 now. Help me to change it and all. It's based on trust. If that Aboki run away with your money, there's nothing you can do. But if Zenith Bank wants to tamper with my money, I can report them to CBN, NDIC, there are institutions that that they have whistleblowing policies and all. And examples of such, there are all these Isusu cooperative and stuff like that. So they are more like unorganized small groups and everything and all. So, but it has its own advantage. It's convenience and little bureaucracy. Sharp, sharp, you don't get money. Sharp, sharp, you don't put money there and all. Soft terms and condition. And just to use this as an example, I don't know some of us that may be operating maybe cooperatives or thrifts and all. If you look at the rates that I happens to belong to one society like that, just a way of looking for how to diversify your portfolio and to get the best returns or rates in the market. I joined the cooperative societies, and the rates that they charge is that for every 1,000 naira that you borrow, you pay five naira as interest. I'm sure there is no commercial bank in Nigeria that offers that kind of what was it called? That kinds of interest on securities and all. So many of these informal guys, they have soft terms and conditions. Then peer pressure and sanction may be effective in minimizing risk of default. So because Casey now my guy, don't let me do this and all. So I want to meet up. But if not bank, I can go and declare myself bankruptcy. There's nothing bank will do. Go and write off the debts. Hello, I'm done. So as regard the disadvantage, effective cost of transaction may be high because the market is usually often small. So there is no wide range of information, and also because of that, due to the information asymmetry, so there could be some sort of manipulations in the market. Then there's no proper documentation. Then it also hinders monetary policy, and that is the reason why and these kind of things they frustrate the efforts of the CBN, frustrate the effort of the federal government in doing some things and all. But the thing is that in some countries, especially like Nigeria, the informal sector, they're actually large and they are thriving. Okay, as regards securities and negotiated market, I think I've talked about this briefly. Securities market, they are like your stock market where you can trade, and also by nature, security markets, they are formal and also and then negotiated markets. I gave example down here. So you have your OTC and you have your private placements where firms issue stock and bonds to select a group of investors. So in this case, you are not issuing it to the public, but you are issuing it to targeted individuals, high profile individuals that that, oh no, if they should have shares in your company, you are rest assured that it will really boost the financial status of that company. So that's the difference between securities and negotiated. Securities is public, everybody can go there and buy, but negotiated, they are based on personalities and all. Okay, money and capital markets. I think this one, everybody know this one. Money markets, short-term securities like your treasury bills and treasury certificates and all, and the capital markets. You also have that as well. And it involves, especially capital market is usually as it involves big guys in the markets. In terms of like all these investment manager, portfolio managers, all these agents, all these brokers, and all, see all of them in suit and tie. Primary and secondary markets. So one is for new issue, while the other is for old issue. And we should bear in mind, AMA may ask us to differentiate between any of these markets and probably maybe relationship of any of these markets. Or, for instance, they may ask us that what is can informal markets, can it exist without a formal market? Do you understand? What is the linkage between the two? Because there's actually linkage between each of these categories. Same thing as the primary and secondary market. As we said, our primary market is for new shares or new issue, while secondary is for what existing. So they may ask you to, look at the two. What is the relationship? How does one make the other one exist and stuff like that? So let us bear that in mind as we may be tested in that regard for any of those categories. Okay, so we have the evolution of the Nigerian stock market. This part is more of story. It was established in 1960 as a private company bearing Lagos Stock Exchange then, before they later renamed it or thereabouts. And according to Amaye, he said as at the end of 2022, there were 173 listed companies on the stock exchange. And what was it called? When you have to add all these debts and ETFs and everything and all, they amounted to 250. But I'm sorry to tell you that as at today, we now have far lower than that. I think they are currently around 100 or lower than, or less than 100 safe, because we're all aware that many of them, they've left Nigeria, like GSK and the likes. So they have to be delisted and so and there are some companies who just decided to go private. So they say they don't want their shares to be traded publicly anymore. So also we have this clearing and settlement of funds arising from transaction. This clearing and settlement, I think later on in these documents, we'll still talk about it, because I'm going to try to explain the importance of this. It's a kind of body, CSCS. It's a form of body. So they helps in clearing and settlement of financial securities in the market to ensure that securities are properly onboarded and offloaded. But I think later on we'll still talk about it in the what's it called? In the as regard this evolution of the stock markets, that we have 12 sector, namely, if not for time, I would have loved to go to the NGX itself. Then you will see all of these categories. For instance, if you want to pick a company on the stock market, you first pick the category. Which category are you looking for? Is it agriculture? You click on agriculture, then it will load all entities under agriculture. Then whatever thing you want to do, is it their financial statement that you need? Do you want to see their stock performance over the years, stuff like that and all? So easily you can do your industry analysis using the platform, and you can use you can do your company analysis using the NGX platform as well. So they are all classified based on categories. So we have 12 categories. I don't know if you ask us to list all of this. I really do not know. So operations of the exchange, we have the founding members, the ordinary members, and the dealing members. And they said, every what's it called? Every exchange, they have their trading hour. And in Nigeria, we trade within 10 a.m. to 4 p.m. You can't buy any shares or trade any stock on the Nigerian stock exchange market before 10 a.m. between Monday to Friday. So you have to wait till 10 a.m. That's when the market opens. Till 4 p.m. Those that trade Forex, they will know these things very well. And that's why it seems like people that trade Forex, they don't sleep, because they may want to, if you are trading a currency pair that is not Nigeria, you may want to be awake to ensure that you enter that market without, for instance, if it is Canada, I can't remember their time zone specifically for it, but I know that we have a very negative time zone compared to like UK, whereby like we are just 1 hour away from each other. But like Canada and US, you have to stay awake before you can trade their currency pairs and all. So that is that. So every market, they have their opening hours and closing hour. It's just like you going to the office and all. And we usually have opening rates and closing rates. Opening rate is the rate of the market by 10 a.m. and closing rate is the rate of the market by that 4 p.m. However, the connection between all of this is that the closing rate for Monday, for 4 p.m. Monday, will be the opening rate for Tuesday, 10 a.m. So that's how it flows in circle. And for some of us that subscribes to, what's the name of this? What was it called? That I used to receive their notification. The investor mailing list. For some of us that subscribes to it, we see that every blessed day they will send you the performance of every stock. They'll show you the top performing stock, the least performing stock, the mostly traded and stuff like that. So don't let me dwell too much on this. So functions performed by Nigerian Stock Exchange. We may be asked this because NSC is actually a key player in the Nigerian Stock Exchange. So these are the things that they do. I know they provide mechanism for purchases and sales of shares. Just like I said, you can go to their website, you see all of these stocks and all, and you see the ones that you can buy. Though you can't buy directly from that app, you have to from that website. You have to go through a broker or a banker, but they'll still buy from that platform. But there's a way they go about it. Provides liquidity to the markets. Liquidity means cash. Liquidity means ability to sell your assets or your financial instrument. So NGX assists in providing liquidity to the market for the benefit of investors because they help in bringing in listing new entities. Sorry, please. Am I alone? Because I've just been talking. Am I alone or we are with me?
No, you're not alone.
And am I
You
making
are not
sense?
alone. We are
You are
together.
not alone.
And am I making sense, please?
You are making sense. Who is Michael
Yes.
Jackson
You are
singing
making
here?
sense. We are enjoying your
Who is
lecture.
Michael Jackson?
All
Sorry,
right.
2AO.
You deserve
2AO,
you deserve
Ajibike.
accolades and standing ovation.
Ajibike. Hello, Ajibike, can you hear me?
Yes.
Please send your
Okay.
account. So if you don't send it tonight, what's the long here?
Yeah, I will do that.
Send, post it
Maybe the
fast,
person
I
did
beg.
not need it. Why are you forcing me?
I think if you don't need that, you can pass it out. You can pass it to anybody on this call. So I'll give it to the person.
Let
Oh
me
yeah, send
send
it
Ajibike is
my
a
fast.
account
I
stockbroker.
can help.
number.
Ó
I
wà
can help
lọ́wọ́ ẹ̀ o.
you.
Ajibike is a
I can help
I
stockbroker. Ó
can
wà
you.
help
lọ́wọ́
you.
ẹ̀ o.
Can you imagine? Okay, so let's continue. So liquidity has to do with it has to do with providing more cash to the market, or it can be used in several contexts. Sha. Liquidity basically means ability to convert a financial instrument into cash and all. And that's why we can have some assets that are liquid and there are some that are not liquid. For instance, real estate is not liquid. I cannot just say I want to sell my house today and I will see a buyer. Else, if it is in Lekki, even if it is in Lekki, you know how long it may take you. Imagine having it in places like Oshogbo. Sorry, not Boshima, anything, but I forget what I'm saying. But compared to like stock, if you buy stock on apps like True or on like Bamboo, within 10 minutes you can get your money out. If you have money in Forex, within 5 minutes, nanoseconds, your money is out. Same thing as crypto. So this market, they are highly liquid and all. And there are a lot of things that determines the liquidity of a market. That's another conversation for another day. So the NGX assists in providing liquidity by ensuring that new money are coming or new guys are coming into the market through the capital market. And that's one of the advantages or the benefit of the capital markets or the importance of the existence or the importance of the capital market for the existence of the secondary market. So because the what's it called, the capital market also provides liquidity to the secondary market because capital markets brings, so what am I saying? Primary market and secondary market. Sorry, pardon me. Primary market and secondary market. Primary market provides liquidity to the secondary market because primary market is the new guys. So, and based on the fact that primary market has brought them into the market or not, with that, the secondary market can absorb them. And with that, new money, new funds is flowing into the secondary
Okay.
market.
BBM, let me crack my
Yeah.
jokes here. Like I cracked the jokes
Okay.
yesterday that the market where you can find virgin is primary market. But what you can see, what you will see at secondary market that is virgin. So if you want a fresh new shares from the source
Exactly.
that has not been touched, it has primary
Oga,
market.
why
But if
must
you
you
want
crack
those
this joke now? Why are you
I'm
messing with
not
our
sure
head?
this
This is
market is
crazy.
for
This is
Junior,
secondary.
this
must
so
you
is
any
talk?
market
Must
where you
you
can
talk?
find virgin.
must
Okay, bye
you
bye.
must
I'm
you
going.
crack this joke?
I'm choosing well.
So
Junior,
does
must
that
you
mean
talk?
this
I must
market
talk
does not
now.
exist in Nigeria then?
What does not exist
Hello.
in Nigeria?
This market does not exist in Nigeria again.
What are you
Because I
saying?
don't
I
know
don't know about
why
that one.
why
But there's
They
primary
sell
market
shares
and
now. They are
secondary
selling new
market in
shares.
Nigeria.
They are selling new shares now. Those new shares are virgin now. That's what I'm saying. Where are you taking it to, Oga?
Now, look at all of this. Yeah, a very good example is all of these banks that are issuing shares, and many of them did IPO. An IPO is usually from the primary market. And also in
Casey,
20,
don't use. Sorry, Casey, please
yeah.
don't use the example of virgin and disvirgin, please. Use another example. Thank you.
Yeah,
Is
change
it
the topic.
about
Casey,
Don't
see
put
what you
that
are
in our
causing.
head at this time
See
of the
what you are
day.
causing.
okay? Oh, I
My
don't hear
mind is
you.
somewhere else. That's why I said my mind is somewhere
Where
else.
your
That's why I
mind?
said
Where
the
is
market
your
does not
mind? Where
exist.
you put your mind? Okay, confess. Where your mind there? Where your mind there?
Okay.
You need to go. You need to go and disinfect your mind.
Please let's
BBM,
continue. We want to go to bed.
BBM,
Yeah,
check
yeah, I'm with
the
you.
chat. Check the chat. Someone is saying hi.
He's one of my senior Jare. Don't worry, I will.
Oh. I've forgotten that you are sharing your screen. Okay. Our manager think we review.
All of us will be fine. Okay, so like I was saying, I was explaining liquidity. So that's how liquidity works generally. So it also provides mechanism for price discovery and signaling in the capital markets and all, which helps investors and regulators to take appropriate value, blah blah blah, or provides indirect manner opportunity for firms to raise capital for the market. Just like I said, the way CBN say, okay, you guys, you bankers, go and increase your capital base. So many of them have to run to NGX to go and raise money. Imagine they are not public company. They can't do what they are doing. Whereby, like, GT shares, the advertisement was almost everywhere. If you enter your car, you see the advertisement. If you enter your fridge, you will see it there. It's because they are listed companies. That's the reason why they could see it. But imagine one company that is Oladino Limited. It cannot be doing all of these things and all. So that is the beauty of the Nigerian Stock Exchange, what it offers. So it enables them to raise capital in huge amounts and all. So an NSC complements SEC towards ensuring the maintenance. So SEC is the regulatory body for NNC because that's Securities and Exchange Commission. So that's how it works. Okay, operations of the exchange. Wait, this is an error. I've seen it here. I've seen it before. Functions performed. I've discussed this before too. Key operators in the Nigerian Stock Exchange. We have the stockbrokers. I think I've mentioned some of these guys. So these guys, they take the mandates from clients to buy and sell. For instance, you may have your stockbrokers. You have some couple of them that are some stockbroking firm. You have kind of like Meristem, Chapel Hill. We have quite a good number of them. So you can just reach out to them that, hello, please, I want to buy First Bank shares, so amounts. Help me to buy it, maybe at this price, or tell them to find a very good entry for you. Then they will execute it for you and buy it. You just receive the mail. You've bought this also shares and everything, pam, and that's all. Let's say you want to sell too, just reach out to them. So that's how all of these $10, they don't have the time, seeing that they now want to go to the markets themselves or stuff like that. They have brokers that they reach out to, just call them. I need us to execute this and all. ASAP, the brokers, they will do that immediately. So as Amma stated here, there are presently about 2 to 3 active dealing members in the markets. So that's the number of stockbrokers, registered stockbrokers that we have in the Nigerian stock market at the moment. So we have jobbers. This is the class of stockbroker who may make markets on a stock by making a two-way quotes of stocks in which they specialize. You see, these jobbers, I honestly do not really understand their work like that in the market, but I know that they work together with the stockbrokers. But in reality, I don't really know what separates them from the jobbers. Institutional investors, they're like the big guys, like in form of like entities. They're like, we call them whales as well. These are guys that they are buying shares in millions of dollars, billions, not all this. Please, Kazim, I want to invest. Can you please advise me? How much do you have? I have 20,000. I have 50,000. We're talking about the big guys, the whales in the market, the guys that if they buy let's say they say
I
they
think
want
your
to
voice
buy
is
shares.
downgrade there.
No, it's not Kazim. No, now I'm just trying to make it relatable as much as possible. Just to let you know that
BBM,
your 50K, your 20K does not move the
BBM,
market. Yes.
These stockbrokers,
Yeah.
these 2 to 3 active daily members, can it be individual? Can it be company?
And there are criteria for you to be a stockbroker. And one of it is that you must be a registered company. You have to
So it
be a
cannot be
registered
an
company.
individual.
It
All
cannot,
those people
you
wearing
cannot enter the, what do you say?
all those people wearing red bib that we normally see on the floor of the stock exchange, who are they?
They are registered through an entity. So not they as a person. Because okay, imagine there is a loss or something happened in the market. How do you want to defend yourself? How do you want to reimburse your clients that are, your big guys that you're representing? Personally, you don't have that indemnity. So usually they are often being required to be registered as a company. So you may not have physical office or something like that too, but you have to be registered because SEC must approve you to be a stockbroker. And SEC does not deal with individuals; they deal with entities. So
So
that's
all
it
those people
usually.
with red bib, they are representing companies.
Exactly. They are either for one company or the other. That's it.
Ah,
They are not there on their own. If it
okay.
is like that, then anybody can just go there and do
No,
whatever
now,
thing.
no. Even if it's individual, there are requirements for you to become a stockbroker that you must have passed the exam, CISA. Then there are other requirements. So
Um, I think
anybody will still not go if it is individual.
I think the way CISA works is that it's just like you having an account too. Do you
That's what I'm
understand?
saying.
It's
That even if
complementary
it is
being a broker.
individual, there are requirements to be fulfilled. So anybody will still not go if it is individual.
Well, anyway, but they are usually companies. Many that I've seen, I've not seen an individual, and or you can just say okay, you are a stockbroker as a profession, but it doesn't mean that.
Because I know that part of the requirement is CISA, then you must have practiced or under a firm for like 10 years. So many requirements. I know,
So
sir.
in that kind of instance, there's such a thing under ICANN too that you must have practiced with an accounting firm before you can have your firm, stuff like that, and no. So it's just to ensure that you really know what you are doing and you are qualified to be in the market. So and at the end of the whole show, you have to come in registered with a name, just like for you to have accounting firm too. It doesn't have to be limited. It can be ANCO. You have group of people coming together and everything. So it's a way of spreading risk and ensuring that there's no high exposure in the market. But like I said, many of the big guys that I know, they are companies. In fact, I've never seen maybe any self-acclaimed independent broker, which seems to be bigger than all of these banks that
Which
are
big guy
stockbrokers.
do you know? Which big guys do you know? Do you know me? I saw you know
Okay,
big guys.
you'll be fine. So institutional investors, these are like waves. These are guys that their actions in the market can change the entire market. And we have retail investors. Those are like people like our governor. They only have small money, 5K, 2K to invest. Okay, so
Ayé mi tèmi bá mi.
market structure. So I love the fact that Amma brought this concept of market structure to the class because it actually shows what is currently happening in the Nigerian stock exchange market. Because it seems like the whole of the market is just controlled by just some 6 guys, and that's all. And some set of guys rather, and they control about 60% of the entire market capitalization. Market capitalization has to do with the number of your shares multiplied by your market share. Multiply by your market price per share. So let's say you have 100 million shares, and your market price per share is like, let's say, 50 naira. So that's 50 times 100 million units and all. So the entire capital market capitalization, that's like adding for all of the companies on the NGX. So 6 companies, namely Dangote Cement, MTN, Airtel, Bua, Nestle, and Zenith, they control 60% of market capitalization. And this is to tell you how small and how easy it is to manipulate the Nigerian stock exchange market. Because how will 6 guys, how would they be having 60% of the entire market capitalization and all? So it says a lot about the Nigerian market, and about 9 and the above to 9 others, they control 85% of the entire market. And that is the reason why Nigerian billionaires and all all of them, they have exposure to the market because that's where they see money. But many of us, we may not know. That's why many of these guys see money. Is he Otedola? Is he Dangote? Is he Elumelu? Is he Rabiu? All of them, they are all exposed to the market. And that's why they see bulk of their money and all, apart from the companies that they owe. Because for instance, when was that that the news declared it, that was it Oando or this company that they said, this oil company that I said Tinubu is related with? Since when Tinubu became the president till now, they said the stock price has done like times 10. So imagine you put 10 million naira last year before what was it called? Before before Tinubu came on board. By now, you'll be 10 times richer. That means you've even catch up with inflation. What is inflation with you? You've made a lot of money in the market and you are fine. And same way we had a drama last year between Otedola and Elumelu, and Transcorp did times 5 within 11 days. So these are like exposure. These are the juicy things in the market. What makes it really interesting, how people see money and how they cash out. And it's because of how small in a way, or not really small, the fact that the market is being controlled by very small numbers of individuals. And that is the reason why they could do many of those things. So once there's one big issue like this or one big fight, you just see their share price jumping, pia, and all. And before you see it, you've cashed out. And people like Otedola, and I used to say it, sorry, I'm digressing a little bit. I used to say it, Otedola is one of my favorite guys when it comes to Nigerian Stock Exchange. He understands it more than many of them. Otedola will buy a share today, he will pump it, make money, sell it, and get out. That's where he makes his money the most. He just scrap the market, make money here, sell that company, go and buy another one, pump it, go elsewhere, and all. So that's how these guys, that's how they make their money. Premium board, well, with about 8 most capitalized stock, very liquid and all. I mean, this has to do with segmentation of the markets and all. We have some small stocks as well. But this main board of 190 stocks, I don't think is applicable anymore. I mean, currently, due to the current situations of the economy and the markets. How do we improve competitive posture of the Nigerian Stock Exchange markets? Who wants to answer that? How do we improve competitive posture? I mean, in essence, how can we make the Nigerian stock exchange market, how can we make it much more competitive? I mean, to keep it the answer short and simple, there should be more participation. The fact that we're having 60%, 6 companies holding 60%, it shows that there's no competitiveness within the market. More guys should come. I mean, Nigerian Stock Exchange should encourage companies to list their shares, and also there should be more participation. So when there's more participation, there's more player. It will increase competitiveness within the markets and all. So that's. So buying and selling shares in the stock market, I think in a way we've mentioned this. So CSCS, this is the full meaning. Central Securities Clearing Service. Like I said, they just, okay, let's do it here. Before trading in the market, clients or investors have to first open a CSCS account. Stock account is equally opened with the dealing member. Like I said, you cannot buy shares or sell shares without registering an account with many of these with an app or with a broker, or what's it called. So all these broker or all these app, this is what they do, and that is the reason why if you register now you won't have access to trade immediately. They will delay you for some hours. That's because they are trying to onboard you on the CSCS system. So with that, they also run some KYC checks on you to see some of the things that you do and everything and all. So, and that leads us to our second point. Dealing members is expected to do a KYC check on the clients. You want to open accounts on Truth. You submit every details about you, including maybe, I think I guided someone on registering Truth recently. And I think they asked for BVN, either BVN or N9. They ask for either of the two and all. And so these are just for KYC, just to ensure that, I mean, they know who you are, and so that in case there's anything, they can easily come for you. A client issues a mandate to buy specific feature to be included, blah blah blah. I don't know if to explain. I don't know if to explain all this. Okay, a client issues a mandate to buy or sell specific stocks to be included in the mandate. To be included in the mandate form includes quantity and price, which can be in form of market or limit orders. I don't really want to go into this conversation, into this what's it called, because you see this market, especially this limit order, it's a bit complex. Like I said, I said individuals or investors, they can give order to their stockbrokers that, oh, please help me to buy these shares, sell that shares for me and all. So that's what they're saying here, that clients can issue a mandate to the broker that, okay, buy or sell this for me and all. So, and the order could come not really in two. If I should open my trading app for you, you see many of the options. We have market order, we have limit order, we have OCO, there are plenty and all. So this market order is saying that buy for me with the current market price. So that's what it is. So Dino can call the stockbroker, please, I want you to buy Zenith Bank stock for me right away, now, with the current market price. So, and the broker will go to the market, execute the transaction ASAP, and it is done. So this limit order, it has to do with, let's say the current market price of Zenith Bank, let's say is 15 naira. So Dino can call his stockbroker that, please, I want you to buy Zenith Bank stock for me once it drops to 45 naira per share. Mind it is currently trading at 15 naira per share, but buy it for me immediately once it hits 45 naira per share. So that is a limit order, because you've already set a limit that buy for me only when the market comes to this price. If the market doesn't come to this price, please don't buy for me. So it is an instruction that you are giving into the market, and there's a way you can set it. Once you set it, just go and play. Once the market comes to that level, it executes automatically. And this thing that I'm saying is only applicable to stock. The understanding can be applied to forex market and can be applied to crypto markets and all. There are times that I may be due to work, I may be busy and all. I'll just say to my trade, please buy Bitcoin for me once it's touched 55,000 naira. $55,000. And then I'll continue with my daily work, 9 to 5 work, everything and all that. It's maybe later in the night, I'll be like, oh, let me even go and check if this trade has triggered. I'll be like, oh, wow, it has triggered. And I'm even already in profit while doing some other thing. And it could also be the reverse. The trade may never hit that market, and maybe the market went up. So I've missed out of it. So these are market or limit orders. That's how it works. The orders could equally be specified as good till month, good till day, fill, kill. All of these are jargons that they use in the market and all. Good till month, keep it till some particular point in time. So it may be to the end of for a month, or what's it called, or for a day, or fill. When they say kill, that means instant execution and all. So they are all jargons that they say in the markets and all. So daily members logs in the bid. We all know what bid or ask price is. Bid, the maximum amount a buyer is ready to pay. Ask, the minimum amount the seller is ready to accept. And what is the difference between the two? We call it spread. And spread determines your profits and all. So let's say there's something I want to sell my phone. I say I can only sell it. The minimum I can sell it is 150. But he's saying that no, the maximum that I can pay for that phone is 140. So that's the 140 is the bid price. My own 150 is the ask price. The difference between the two of 10,000 naira, that is the spread, and that is where profit lies. So if Dino is able to buy it for 140, he has made a profit, a spread of 10,000 naira. If I'm able to sell it for 150, I've made a spread of 10,000 naira as well. So market is all about somebody have to lose, somebody have to gain. It's a rigged system. So we live by it. Daily members.
The buyer is the one making the bid.
Yes.
Why the seller is the one asking
exactly
how much he is willing to collect.
Yes. The minimum is ready to collect from the buyer.
Okay.
Okay, so daily member is
seller is offering the minimum he can sell. Why the
Yes,
buyer
because
is
as this
bidding for the maximum he
the
can
maximum
pay.
I can pay for this thing. So that's the concept of bid and ask. Bid, this is the highest I can pay for this thing. I cannot pay anything higher than this. But the seller, that is the ask. He's saying that, okay, this is the minimum that I can sell this thing. If you are not buying, leave this place.
Noted. Thank you.
All right. So dealing member is expected to execute this mandate within 10 working days, blah, blah, blah. But depending on how the market operates. But in real world, now if you set up your bamboo account, within 5 minutes, you buy shares of any companies. And I actually could remember when I used to buy stock before I joined KPMG and all, buy Tesla stock within a minute, you buy it and all and stuff like that. So I mean, the market is very easily you can buy stock, easily you can sell. It is highly liquid and all. And all of these things that we are seeing is not only limited to Nigerian stock market, is applicable outside. So, and this is also an encouragement for some of us that are interested in buying shares, and also we can mix up some of this platform. We can buy stocks that are not even in naira, dollar denominated stocks like Tesla, Apple. You can buy them, you keep them, you gain more value in dollar as well. Stock appreciation, and you also receive your dividend annually. So it is a good thing.
Acceptable as low collateral?
What's that?
Your shares stock certificates.
Yes, it can be used as collateral, and just as an opportunity to just use this to also digress a little bit to explain what Elon Musk did when he bought Twitter. Do you know that Elon Musk used his shares in Tesla as collateral to go and take a loan so he could buy Twitter for $40 billion? That was what he did. So with that, he was able to evade capital gain tax, because if he sells his shares, he will pay capital gain tax. So because of that, he didn't sell the shares. He used his shares in Tesla. He used it as security against the debt that he went to go and take from the bank to buy Twitter. So it is highly, in fact, you see many of these banks that gives out loan, they love it because they know that, because they'll be praying that you should default, because they know that if you default now, they can sell that shares. It is highly liquid. In fact, they prefer it to you using
the price
house.
of the shares has dropped.
It's all about risk, and that's where you negotiate when you are securitizing your stocks and all. So in fact, these guys, they prefer, these bankers, they prefer it to you using buildings or maybe one plant or your business or something as collateral. I mean, shares is one of their favorites. And even if they did not sell it, they can do a change. I mean, they can sell it and then they will buy it. So with that, it becomes part of their portfolio. So they will keep it to when it will become profitable. Then they can sell it. But they can take the ownership away from you at any point in time. So that's one of the advantage of having stocks. You can use the certificate as collateral for debts. Cost-driven quotation system. Man, I want to do this table that we did though. This one that I'm talking too much already.
We still have tomorrow now.
Okay, no problem then.
Tomorrow night.
No problem. So the cost-driven quotation system. This is the quote system where prices are determined on the basis of bid and ask price by dealer who play. You know what? Just a minute. I want to show us something, since I can take the what's it called tomorrow to make it much more. I just want to quickly show us something so as to explain what we are doing here. That's not what I'm looking for. Sorry.
Ó mà pẹ́ tí mo rí kó tó celebrate value Bitcoin ẹ̀ ọ̀wọ́ ẹ̀ ṣé wọ́n yẹ pé owó ẹ̀ ti já wálẹ̀?
Ó mi àṣìjà wálẹ̀.
Àmì èrí kó celebrate ẹ̀ mọ́ lórí status.
I just do it once in a while now. I don't do it often. I don't do it often. This thing, what I really want to show. Let me use what's it called. And I'm not using my phone. It could have been easy on my phone. But this what's it called is actually not showing what I want to show. What I actually wanted to prove is this quote-driven system whereby like prices are determined by the forces of demand and supply. In essence, the other way it is being written here, prices are determined by the basis of bid and ask quotes. So as what was it called? I say I want to sell something for 150. The one is saying that no, I can buy it for 140. Another person will also come, okay, I can buy it at 141. Another person will say, oh, I can buy it at 142. So the back and forth, the back and forth, the back and forth, and the back and forth. That's how the market sets its current price. I don't know if that makes sense. Just that the thing is not really showing it. For instance, looking at my screen, you can see that this prices is dancing, is changing at all time. You can also see it from here too. It changes, frequently. It keeps changing, it keeps changing, it keeps changing. The basis for the changes is based on the demand and the supply for it, the bid and the ask price. Oh, this is how much I can pay. Oh, I can't pay 60,000. I can pay 61,000. Oh, I can't pay this. I can't pay that. This was called this app to analyze markets is not really showing it, but there's another one that actually shows it, but I don't have access to it from this system. So this is how these prices, this is how they are being determined. They are as a result of forces between the bid and the ask price. That's what determines all of these prices. And same thing with the stock market as well. That GT stock price is now 45 naira is based on how much are people willing to pay for this stock, and also the buyers, how much do they want to sell it. That is what gives rise to how these prices are being set. So it's all about demand and supply, how many people are buying it, how much do people really want it, and all. And also the financial analyst guys, this is how they also know the importance of what's it called, all these market price per share, or there's one time I went to remember an accounting issue like that, maybe any yield or something. I can't really remember. So that's where all of these things, that's where they comes in, and how that's how they use them to make decision. Yes.
Yeah. What you have left to explain with the table, is this something you can close within 1 hour tomorrow? If yes,
Yes,
then
of
we
course.
can go to bed
Within
now.
30 minutes, I can close it within 30 minutes.
The remaining explanation and the table.
The table shouldn't take me long, since some of us already know it, and I will be using Excel.
How about the remaining theory?
The remaining theory, in like 10 minutes, I should close it out.
So definitely we can close the remaining tomorrow.
Yeah. Okay, we should close. Are you suggesting we close the remaining tomorrow?
Yeah.
So what do we think? Casey. Casey don't sleep.
Azim, are you there?
Unbelievable. Almighty Casey.
Azim. He's there now.
But he's not responding.
Okay, guys, what do you think? I want us to go to bed right now so that we'll continue tomorrow, since it's something what we'll have left is something we can close within 1 hour tomorrow. So probably
yes, definitely.
You come in 11 p.m. again, then you close it 11 to 12.
Okay. How about it concludes with the theory this night? Since it's like 10 minutes now.
Yes.
Hello, BBM. Can you help on the slide?
Okay. It's actually one of us that shared it too, but I can reshare it. It's fine.
So that we can have access to it.
It's all right. No problem. So somebody was saying something. Okay.
I think we should stop here.
All right. No problem. Anyone works for me.
We'll complete it tomorrow.
All right. Thank you so much, everyone.
Thanks for your time.
Okay.
Thank you.
Thanks, you.
Good night, everyone.
Night.
Good night, you. At Gominowa.
Good night, sir.
Asunjio. Yes, sir.
Amio.